really tough to try and decipher what to do next when it comes to investments. Firstly, let's start off by taking a look at what clients are actually asking for right now with regards to asset allocation. What is in vogue at this stage?
Well, a lot of clients always ask whether or not it's time to increase offshore exposures, whether they should take some profit off the table. And our view at the moment is that the horse is probably already bolted on the offshore side. If you look at what asset allocation funds are doing, they've already positioned their offshore exposures early this year. As soon as the exchange control lifted the ceiling to 25%, we saw managers buying up opportunities abroad. The rand was then still sub the 8 rand mark, and one stage under 7 rand, which was the right time to be buying assets offshore. So our advice to clients is to be very careful when selecting funds and making sure that your advisor is looking at asset allocation funds.
When it comes to the offshore exposure, given the fact that the rand has weakened to around 8.30 to the US dollar, we've even seen it hit around 8.50. We've seen this kind of news before where a lot of South Africans want to take money offshore. Have they missed the curve, basically? Because you're alluding to the fact that a lot of pension funds naturally have exposure to offshore elements.
Yes, and also I think a lot of managers or advisors are saying to clients, you've been offshore for a long time, you've been disappointed with returns, yields are very low, particularly on the low risk side there, and we've even seen clients bringing money back, which isn't necessarily the long term the right thing, but short term we see you can get 5–6% in a low risk portfolio here, and clients are saying, I'll take that, I'll rather be conservative. There's too much uncertainty in the world, let's err on the side of caution.
Now, we know that pension funds are able to have a 75% exposure to equities. Some say that this is far too high, that we should actually cap our equity exposure to around 50%. Where do you stand right now when it comes to equities?
Well, the pension fund is aimed at providing guidelines for investors of all ages. So you've got a young 20-year-old investing in a pension fund looking for equity with a 30–40-year time horizon. And then you've got your retired pensioner or close to retirement person who's saying, I'm going to retire in 2 or 3 years. They're looking at 30–40% in their equity exposures.
When it comes to inflation, the point is that we have to beat inflation over the long term plus some. That's exactly what we want at the end of the day. What kind of impact is this going to have on retirement? It obviously deteriorates the value of money over long term.
The major impact on financial planning is you make an estimate on what you think inflation is going to be for a period of maybe 30 years. And if I make an assumption of a 5% factor and I'm out by 1%, that will have more than likely a 25% impact at my retirement stage. So every 1% is material. So government's view on targeting inflation is absolutely essential, and your investment choice needs to ensure that it can beat inflation.
When it comes to the amount of money one needs when you retire, of course, that is very hotly debated. Also, you did mention that for every 10,000 rand that you earn on a monthly basis, you need around 4.5 million rand.
Yeah.
When you retire, so just quantify that for us.
Using an inflation factor of 5, I've done some numbers to say that if you are looking for an income, and let's just work on multiples of 10,000 rand, you would need 4.5 million rand to provide you with an income for a 20-year period of 10,000 rand escalating. And do the maths, if you need 20,000, you need to double that and have 9 million rand as a capital base. And that's just 20,000 rand in today's money.
And what is the average number that people usually land up retiring with? Do you find that most people do have 20 million rand or 15 million rand at their disposal for retirement, or is that really an ambitious target?
Sadly, the statistics of only 5 or 6% of South Africans having enough money is absolutely true. And we see a lot of clients having to start drawing into capital. They might need to offload a property and turn that into an income generating asset. They might need to scale down on their cost of living. And of course, the big worry is medical aid costs.
Absolutely. What about tax planning? I'm sure that also ties in with medical aid costs down the line.
Tax planning is probably one of the most underestimated features of financial planning, in that a lot of times the investor or the couple have all their investments in one name. If they were to split that income between a husband and wife, you can almost fall right under the tax radar. So
you need to split
it
then?
Yes, you need to split your income. You need to utilize the tax breaks through retirement annuities to get the relief on the way in. And then in the tax In the investment arena, you're avoiding tax, and then at retirement, post 65, your rebates will then kick in. You also have all your medical costs deductible. And then, of course, there's a range of tax-efficient investments. Pref shares are typical examples, endowments that have a lower tax base than your marginal tax rate.